this time. So I'm on my GU chart, and I have these two levels of there. I mean, it's now resistance right here, but you know, support when it was up here, resistance obviously whenever it's below it. I have these two key levels right here. Now, these are all minor levels. Don't take these as major levels. If I go back to the daily, obviously the major levels would be, you know, somewhere at 130. I have it here as well. I kind of go back and forth with my strategies. I have, you know, 2 to 3 different strategies, which I kind of explain within all the 4 series. In the third series, I kind of break down, you know, the key level strategy and a little bit of scalping as well. But in this one, I want to talk about intraday trading. So intraday obviously means, you know, within that day or you know, maybe the next day, but intraday you try to, you know, hold it at the longest 24 hours. At the longest, usual is like 2 to 5 hours. So when price is at a major key level like it is right here, right? Or a minor key level just in general, I'm looking for a few things. I'm looking to see if price is going to reject it or if price is going to burst through it. And that it's really that simple. Like, I don't want to oversimplify it, but that's really all it is. When price gets here, is it coming full force as a shooting star? And is price, you know, barreling through Maribozu? Or is price stopping abruptly? That's how you can see it. Is it stopping abruptly and then kind of reversing? Let's go to an hour chart. You can see clear as day. Wick, doji, 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 doji. Usually when you see dojis in succession like that, chances are price is not breaking through. We get this consolidation box, price breaks right above it. Boom, that's all I'm looking for. Now we're heading up in the you know, up direction. Now, same with over here. With this major key level, and people may ask how I got these minor key levels. I had this trend line right here from point A to point B, and there was no C. Obviously, if I, you know, let me bar replay this really quick. I'm sorry, I didn't mean to go back. Let me this, boom. So obviously it was like this. This is how I had it the first time. So usually when there's a trend line, uptrend, downtrend, whatever the points are at, I usually draw a line there, right? Cool. So obviously we click play, we bring it all the way to the front. Let me actually just exit all out. So price is here right now. So many people may make the mistake as in, you know, making the trend line like this, but you completely disregard point B. So you got to stay in line with, you know, how it originally is. So I draw my lines at this B point and A point, because usually if price breaks through a trend line, it most likely touches point B and point A. So when price gets to point A, what does it do? Wick, 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 wick. A big, you know, kind of a, it's not even a hammer, it's like a big doji. Another wick, another wick. It wicked so many times, there was no way it was breaking this barrier. So all I'm looking for is a moving average crossover or some kind of confirmation that it's going to head down, like the shooting star or like, you know, even an evening star. But chances are you won't see like an evening star in the middle of consolidation like a doji. You'll see at like the end of a trend. Like if price were going up and then I saw an evening star, then obviously that's where you'll most likely see it. You won't see an evening star where it's like consolidation, bunch of dojis, evening star drop. No, you most likely see like a shooting star or a Maribozu confirmation, or price just starts getting smaller and smaller, which is what you saw right here. Price just started getting smaller and smaller. Moving average crossover, boom, enter. It goes all the way back down, all the way down to this original point. Obviously, it stopped a little bit before to this point, but it should get to at least right here. If not, then it'll go back up, and we'll adjust from there. But that's all I'm looking for. Even back here, whenever we see price at major levels, I can see this level kind of lines up right here. Let me draw this box from over here. So clear as day, we see this. Boom. Price is at this level. Is price bursting through it or is it consolidating? That's what you got to understand, because if price was going to break through it, you can see clear as day with gold. When gold got to, you know, this level, price started getting higher and higher in consolidation, broke through it. Then it gets to this 2,000 range where I usually have my levels at. I deleted it off, but I usually have my levels, you know, every 50 with gold. And what does it do? Goes right through it. So you kind of can tell the same thing with GU, where it's like, if price was going to break through it, it would have no problem breaking through it. But instead, we get consolidation. Look at the patterns. Look at the candlesticks. If you see dojis over and over and over again, start reversing your bias. Start looking at it as, all right, price may have to, you know, reverse and head back down. That's all you got to do. You shouldn't be looking at it as, all right, well, I'll wait to see what price does. No, look at your bias, start to formulate an opinion and go from there. And now over here, we get a bunch of dojis. We get a bearish engulfing, a moving average crossover, entry, boom. Obviously on a 15-minute time frame, but entry. goes all the way down. All I'm looking for is just the eye test. Is price breaking through, or is it just stopping? Over here, doji, 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 doji. Boom, shooting star. Enter. Feel me? Boom, heads up. Small candle. Boom. It's kind of a evening star. Like I told you, you see evening stars at the end of like a, pulling up, then an evening star. You won't see dojis, then an evening star. Over here, consolidation. Shooting star. Drop. All I'm looking for is I just want to see if price is breaking through or halting. If price is breaking through, you may get a quick halt, but it won't be anything insane. Like it won't be, I'm going to halt for 10 days and then push up. You know what I mean? It won't do that. But if price is consolidating there for so long, or the market has already made its move, like it's already made, 3 cycles down, and I'll talk more about that in series 4. But once you get to know it, you'll know how like the market cycles usually are. When you see how price has been going down for so long, and it's like right at a support, and now it's consolidating for a while, chances are it's not going any lower. It's just trying to get a few more buyers to push it all the way back up and grab the momentum. So I hope this video helped you guys. I'm trying to get you to understand there's nothing really extravagant about what you're doing when price is at a key level, but you just look at it, you wait to see any confirmation sign, and you get in. And you take your chances with, if your risk to reward ratio is good at a 1 to 3, 1 to 4, you can't beat yourself up over losses. Losses will happen, but wins won't happen unless you get some skin in the game and you go out there and try and execute and try and mastermind and perfect, your strategy over and over and over again. So like I said, I'm not looking at anything crazy. We get a bounce here, tweeze your bottom, push up. That's all I'm looking for. Price gets to this level. Is it breaking through? Nope. A bullish engulfing. We're heading up. That's all I'm looking for. I'm keeping it very, very simple, and keep that in your repertoire. Keep it simple. All we're looking for is if price is going to retrace or break through it. So let's talk about it. This entry work, let's get it in. You know what I'm saying? So we started off with setting our charts up, and this is where we left off as. The major support is here. Another support is here that we haven't really, marked up because price is way up here now. So I'm going to show you guys, how exactly you should have entered this trade. And I want to get this academy out within the next 2 weeks. So in the next 2 weeks, you guys are going to see, a lot of good videos, a lot of dope videos, but I want to have, record a lot of my live trades. And it may be like I wouldn't say a boring video, but it's just literally me just trading live, like my real-time senses, my real-time environment. I want to have a whole section dedicated to that. But right now, I'm just trying to get as many dope videos out to you guys as I can as possible. Just like I told you guys about, the Netflix stuff. This is season 2 of Secure the Swag. So I want to make sure you guys are studying this. And then hopefully, shortly, a week or 2 after that, I can just upload my live trading in here. It won't be no edits, won't be no intro and outro, just be me purely live trading as well. But right now, so entry work. So the reason why I put such an emphasis on the psychology section and why it is the most important section in my academy, and people just, want to skip over it potentially and just go right to the technical analysis stuff, is because the reason you're losing money is because of your psychology. It's not because you don't know what technical analysis is. Like at this point, I'm pretty sure I can ask everybody what support and resistance is and what a trend line is and what a moving average is, and they can really regurgitate it, or they can say it at the top of their mind and really in definition. And that's not where we want you guys to be. We don't want you guys to just be able to read something or hear something, watch something, and then quote it from a definition, but not be able to accurately utilize it and efficiently execute it on a chart. And the reason you guys aren't efficiently executing it is because of your psychology. You guys are scared. You guys are hesitating. You're second guessing yourself. You lose one trade and you're not confident in the second one. And you have to have such an unwavering confidence about you with this trading stuff. And you have to stay disciplined, because if you don't keep your risk management, which is why I started the whole section off of risk management, it's the most important thing, just like psychology. If you don't keep your risk management in check,
it's easy to blow an account because you're risking too much. So in order to be confident, look at this. The trend line started here, right? It pulled all the way up, right? I see several entries. Pulled all the way up, came down and retested this moving average. Now, since we kind of already know it's an uptrend just from this alone, like we knew this was the low and this was a higher low. Obviously, this is why you want to mark your charts up as much as you can. Low, higher low, you know what I mean? Mark it up as much as you can so you can have an idea. Let me actually make this smaller. Here we go. There we go. So you have an idea. So we kind of already know that this is already a higher low. We get a bullish engulfing. That's two confirmations that price is heading up. We have this counter trend line right here. And a counter trend line is basically a trend line that goes against the actual overall trend, trying to connect these two and not so much far back, but it's more so these two. This didn't really go above it, stayed right here, stopped here, came back down. So once we break this counter trend line with this bullish engulfing, it comes up, it retests this. It's support now because it's way up here, but this resistance, 1, 2, 3 hits. And then it finally breaks through. And mind you, this is a daily time frame. Head down to the 4-hour and a 2-hour. I got kind of caught up with myself because obviously I'm an intraday / swing trader, so I look at the daily and the 4-hour. But for intraday trading in particular, you want to scale down so you can get these, precise entries. You see price. First of all, let's go over here. So you see price make a higher low right here, and it broke through the counter trend line. Not only did it break through the counter trend line, it broke through and retested this moving average. I just made a YouTube video about this as well. It was, I think, the Gold Makes History video that I just released yesterday. I said it then. I said, a trick that you guys can know, whenever price bounces off the moving average, that should be a clear-cut sign to enter. Because price will never just bounce off a moving average and then that's it. Chances are, if it bounced off a moving average, it bounced off the moving average and formed, a pattern, whether it's a bullish pattern or a bearish pattern in the direction of the trend. It broke through some kind of resistance, support, or counter trend line, or the actual trend. You know what I mean? So when you see price bouncing off of a moving average, it is very, very, very sacred in this, in this world. You see over here, there's no bounce off of a moving average. It's going right through it, and the moving average is trading in between it, which shows that it's consolidation. Whenever you see price clearly just bounce off of it, like over here, you see price go down, it came up, it bounced off of it, boom. What is this? Bearish engulfing. Regular candlestick, bearish engulfing. What did it do? It dropped down 124.5 to, that is about 120 pips it dropped down. So be mindful when price bounces off a moving average. So it bounced the moving average, gave us a tweezer bottom, boom, your entry can be right here. On the aggressive side, I'm gonna show you guys an aggressive and more passive way to enter. On the aggressive side, your entry is amidst of the close of this tweezer bottom right here. What am I trying to look for? This line, yeah, this, thank you. Amidst of this close, let me make this bigger too. So you got to understand, the reason why I say miss it this close is because price can go down and come up, and then before that 2-hour candlestick closes, it can still close down here, which shows that it's not enough, momentum, and it'll head back down. The fact that it bounced off of the moving average with a tweezer bottom, the aggressive side would be to enter here in a long position, and this is where the entry work, the sniper entries come in. Aggressive, stop loss right below there, and your take profit, several take profits. Your first take profit is clearly to this key level, 1-to-4 risk to reward ratio. Clearly, that's the first one. Once you start to take partial profit, or if you enter again, well, I'll get to entering again on another video called Scaling In. Let's just talk about the entry work just in general. Once you enter right here, excuse me, I talk about it all the time when moving your stop loss into take profit. Now, you only do that when the market creates actual structure. What I mean by actual structure is In an uptrend, if you see a higher low, higher high, higher low, your stop loss goes below the last higher low. If you see in a downtrend, lower highs and lower lows, then your stop loss goes above the last lower high. So over here, our entry was here, right? A misses, closes, tweezers bottom, aggressive, a little aggressive, right? But it's not so much aggressive. We have several confirmations. We broke a counter trend line, had a huge bullish engulfing. Number 2, 3, the moving averages crossed back over at the red over the blue, then cross over blue over the red. 4, we have this, bounce off of the moving average. 5, we got a tweezer bottom. There's so many confluences why we got in. It's not so much aggressive, but it's still a little aggressive. So right now, we enter straight in. A little bit of negative right here with this wick, a little bit of negative, straight in. It goes right to this major resistance, which obviously turned into support later on, but this major resistance. And then what did it do? It came back down, and then it slowly starts to trade back up. The minute you see price make a new higher low, this stop loss, it won't let me do it here, but in MetaTrader it will. You move this stop loss into break even and actually into profit. This is now the next higher low. So now your stop loss, instead of losing 200, 300, 500, 1,000, 150, whatever your stop loss is, you are now guaranteed to at least make some money. So if price were to come down and hit this level, get the brush tool, and hit this level right here and stop you out, you at least got stopped out in profit as opposed to negative. But guess what? You cannot do that if price is not creating structure. You can't just get in a trade. The minute you see profit, move your stop loss into profit. It won't work. It has to come down and create a higher low, or go up and create a lower high in a downtrend before you can be able to move your stop loss. So now we're able to move our stop loss. And now we're able to let this trade roll freely and add it again to the next level, which is 127,500, all the way up here. We drag it all the way over, and guess where our stop loss is? Still right here. Now you have several different ways to, move around with it. You can obviously move, from here. You can move it over here. New stop loss, obviously drag it all the way over. It still has not been hit. And then obviously another stop loss. Again, move it here. It's finally been hit when it came back down over here. And you can find some ways to kind of, really avoid that as well. You can obviously take this rectangle, move it all the way over, way up here, where it's like, all right, I see one hit to the resistance, another hit to the resistance, another hit to the resistance. That's 3, I wouldn't say a triple top, but it's 3 different ways as to where prices, boom, 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 clearly couldn't break up. You can easily take your money, it's obviously a bearish engulfing right now, and a red moving average cross over the blue. You can easily take your money and obviously get out, or you could let it play through since it's a risk-free trade and not really worry about it too much. And then obviously it drags all the way down and hits this level. So those 2 things you want to do, obviously, as well for your entry work as well. I'll talk about scaling in a whole nother video. We won't worry about that too much right now, but we're just worrying about actually entering for the very first time on a trade. You want to make sure you are as, precise as possible, and that's the more aggressive side. Let me get you in on the more, I want to delete that, on the more passive side. So more passive would be to obviously wait for it to clear this, resistance, which is now support. Wait for it to obviously clear it. Once it's cleared it, then it's a matter of, all right, let me get in and watch what it does. And your stop loss, this is the last low. So the stop loss is right below there. So right here, stop loss. Entry could have been right here. And obviously you got way into profit, comes down, it gets negative again, but then obviously slowly have to go up to this 1.27 level and the 130 level, which is long term. But overall, we want to be as, non-aggressive as, it depends on the type of trader you are, which is why I said when you're setting up your charts, figure out what type of trader you are, whether you're an intraday, a swing trader, or a scalper. Depends on what type of trader you are. Once you figure that out, then you kind of figure out if you're an aggressive trader or a passive trader. You can't trade in the market without knowing exactly what type of trader you are, because you're just going to do a bunch of things around the world. You do a bunch of nonsense, do all this crazy stuff where it's like, all right, cool. Sometimes I'm aggressive, sometimes I'm passive. You can't be that way. You have to figure out what strategy works for you and then kind of go from there. You know what I mean? Right here, we have a major support as well. Like I said, just make sure you understand what type of trader you are. Figure that out. Once you figure that out, everything kind of, makes more sense. You can be aggressive, you can be passive. Or if you're a swing trader, you can do that consistently. You can't go back and forth. You can't go from, being real physical with the market, basically aggressive. You can't go from, real swinging to real intraday to real scalping. You can't go with those three different ways and back and forth and back and forth and back and forth, because if you do that, then obviously you're not being consistent. You're not focusing and honing in on a strategy. You can master a strategy. Me, I'm an intraday swing trader, but I didn't start off as a swing trader. I started off with being the best intraday trader I can possibly be. And once I did that, then it was all right, I can hold these trades a lot longer and be more of a swing trader. You know what I mean? I can kind of do both, but you can't start out the gate doing both, because they say the person that chases 2 rabbits catches none. Catch 1 rabbit first, and then if you want to, then feel free to learn how to scalp or learn how to trade more and hold it long term and be more of a swing trader. But right now, let's just knock your strategy out, have the foundation, figure out what type of trader you are, create a trading plan. I have all the trading plans in the tier 2 course as well, but create your own trading plan, create your strategy based on what I'm teaching you, and figure it out. That entry work is very, very, very serious. You want to make sure you have the best entry possible. And here's another thing. I talk about this in the risk management section as well. If you lose a trade, it's okay. You know what I mean? You're not going to win every trade. You're going to keep losing. You're going to lose some trades, here and there. But it won't affect you if you're so disciplined and your risk management is on par. You guys are so eager to chase money, and you see me making so much money. I wasn't making that my first year, my second year, and even my third year. You know what I mean? I was making a little bit, but I wasn't making tens of thousands, the 6 figures and 5 figures. I wasn't making none of that in my first 2 and 3 years. It takes some time to master a craft. You know what I mean? So what you guys got to understand is keep your risk management great. Whatever works for you. What works for me is 1 to 3 and up. I don't trade anything that's less than a 1 to 3 risk to reward management. You know what I mean? I don't trade that at all. So obviously, if I'm trading what I had earlier on my 2-hour time frame, and it was a matter of let's say long position. I think I got in right here, or the other one. My stop loss was right there, and my take profit was way up here, 127, 1 to 7 risk to reward. The one from here to here was 1 to 4 we did earlier, and way up here, 1 to 14. You know what I mean? You want to have the highest risk to reward ratio possible, because it means I have to lose 7 trades in a row and win 1, and I'm still in profit. Or I got to lose 5 trades in a row, and all I got to do is win 1, and I'm still in profit. You know what I mean? So you want to make sure that your risk to reward ratio is always great, because if you do a 1-to-1 risk to reward ratio, at the end of the day, you can lose 10 trades and win 1. You're a negative trader. We want to have percentage growth. We want to have consistency, and all in all, we want to have profit in the market. So I'm getting a little long in this entry 1 video. I want to kind of break it up. So I'll do an entry 2 video as well. But I want you guys to kind of figure out exactly what I'm saying. You know what I mean? So it can kind of, you guys can kind of relish in it and understand it and incorporate it in your brain. Risk management, discipline, and focus on your entries, and keep your stop loss, where structure is. Don't try to keep it as tight as possible. Make sure you keep it, due to what structure is saying. If you try to keep it as tight as possible, but it's not going with structure, you're going to lose every single time. Keep it with structure. Put it below the last higher low in an uptrend, or above the last lower high in a downtrend, and you'll find yourself more profitable than not. Talk about it. Our entry work part 2. I wanted to split this video up into 2 videos. Y'all see me looking at the lyrics to Chris Brown. This song is fire. But irrelevant. Right now, we are talking about entry work. So right now, I want you guys to look at, entries as a segue to being a great trader, because obviously you need the psychology, you need the risk management. But with entries, you don't become a profitable trader if you are not, specific and methodical with your entries. I say this all the time. Anybody can accurately predict where the market is going to go. It's just a matter of timing, and that timing comes down to entries. Now, I have one of my favorite pairs here, GU,
here just in general. And I want to give you guys an example on what the daily, the 4 hour, and all those time frames are usually for. And mind you, remember, we're talking about intraday trading, meaning we get in, we get out the same day. Understand that the daily time frame is not to be looked at to be traded on. For example, we're not looking at, okay, it went up right here, so way up here, all right, it's still in the uptrend. Or, let's say, for instance, screw all of this, it dropped right here, so we way over here right now, and it's going to keep dropping. No, we don't look at the daily for that because it's going to take too long. You guys are intraday traders. But the daily can be a great tool to help us get better entries. And let me elaborate on that. So, if you are looking to enter a pair, or let me take that a step further, if you haven't entered a pair yet and you're looking to see what the market wants to do and like the bias for the pair, start off on the daily for sure, right? And when I talked about my last video, like I talked about, analyzing and really breaking it down in the 4 hour and below, but the daily leaves clues in terms of what it's going to do going forward. You see right here where you get this, some type of right here, you get a tweezer top right here, right? You get it right here, and it matches a little bit lower, but it matches the similar resistance of the previous tweezer top it did. So let's just draw this, this key level over here, right? This resistance. And now we have one tweezer top drops. One tweezer tops drops. Now understand, once you see this red candle and this tweezer top on the daily on May 1st, this was on a Friday, right? So this is on a Friday. So on Monday when it opens back up, you should be looking at the 4 hour and the 1 hour to see, all right, what is the market going to do? Where can I find my entry to go down? Because once you see it on the daily, all you got to do is get onto the 1 hour and the 4 hour, and you can see clear as day. Boom, drop, slowly decline. Moving average crossover, a little bit of a spike, boom, drop. Your entry could have been any one of these. Preferably, let's go back to the daily really quick. All right, so we see we need this whole candle to drop first. So we're going to draw a nice little line right here so we can at least see where it stopped at in terms of like finishing the candle. We go back down to the 1 hour time frame, head all the way back over. So you can see right here, and this is so clear as day, which I'm glad. So your entry easily could have been any one of these. So look at this. This was where the tweezer top closed at on Friday. On Sunday, when the market opened, what did it do? It came down, retested this area, which was where the tweezer top was, right? Retested this area. Once you get the retest of this area, you easily could have gotten in, and I'm going to be very transparent with you guys, once the moving average crossover. So it's not just this candlestick right here where you see like, okay, and this is where you got to put all the tools together. Remember what I told you. If the moving average is in the middle of candlesticks, it is still consolidating. So no matter if we got this retest and drop back down, it would affect a lot of people out. The moving average is still in the middle. Red isn't over the blue yet. So that's not enough confirmation. This is where you got to exude patience. Over here, this is a retest, still nothing. We need a moving average crossover, and you can slowly see how it's crossing over in between. Your entry could have been any one of these. Any one of these, because you already got the retest. So understand this. Once you got the retest, you got 1, 2, 3, about 3 retests already. And then you got a moving average crossover afterwards. More times than not, the candlestick that you are entering on or anything going forward will not come back and retest it again. Doesn't need to retest. It retested it 3 times already, and the moving average crossed over. If the moving average didn't cross over, it can retest as many times as it wants. The fact that it retested 1, 2, or about 3 times, and then the moving average crossover, you know for a fact, all right, it's going down. Just a matter of me placing my stop loss. That is more of the key. The entry is a little bit easier. You could easily enter on this. Let's just say we entered, somewhere around here. Let's just say we entered on this one right here. Stop loss could either be right above here or right above here. Preferably, we want our stop loss a little bit higher. But if you want to get sniper-like entries, you could have did a stop loss right above this little lower high. But the more conservative approach would be above here. I'm not going to tell you guys exactly what you should do. I personally would probably have put my stop loss right above here, and once it dropped a little bit lower, then move my stop loss to like right here, and then when it drops some more, move my stop loss to right above here, over here. You know what I mean? But initially, I probably would have had it right here just to give myself some more breathing room, because even though it wouldn't have retested, excuse me, it could have easily, just like it did this wick right here, wicked out, stopped you out, and then dropped. So more times than not, the correct way of trading is to place your stop loss above the original last, lower high in a downtrend. So we have our stop loss right above there. Now, take profit wise, we got to look at some kind of key levels. When I say key levels, I mean in terms of just support and resistance in general. So we go back to the past. We see price stopped right here before heading all the way back up. We see price stopped right here before heading all the way back up. And we see price stopped right here before heading all the way back up. And this 122 comes in at around 123 flat. This comes in around 122,500. And this comes in around 124. If we draw obviously a rectangular box around this, which was in that range. I can delete that right now. So in order to actually and actively trade, we would have dragged it down, and I wouldn't have had it right here, because I feel like if you go back on the daily, this is where you got to be smart and use your eye test. If you go back on the daily, we see a tweezer top on a daily time frame. Chances are it's not going to just go right here and then go back up. Not at all. After we see this big candlestick formation, I'll get more into this in the actual candlestick patterns and formations, just in general. I think it's in another section in here. So chances are it's going to go a lot further than that. So this is where you use your prediction, and you predict that it's going to go a lot further than what it shows. What it shows right here is, in the past, GU, while it was on the uptrend, it started right here, stopped right here, stopped right here, and then it got right here in reverse. All four of these are key levels in terms of where price will stop at, where you should place your take profits at, where price will stop at again in the future. So since it's so close, I would have put my take profit to this one originally, had this as my first take profit, this is my second one, and honestly, I would have had right here, the stoppage right here, this is my third one. Until price gives me a reason not to get out. You know what I mean? And if price would have dropped below here and even closed, then my take profit would have probably been, I see price stopped right here before heading back down, somewhere right here. Now, I use these, these little levels, these little mini levels on top of my actual key levels. The key levels, I have it off like the eye test, and have it in general with, what I usually see from, my eyes in general. I don't draw too many specific key levels on here because, like I said, with naked trading and with the eye test, I already know it by heart. So delete this, have that off. Now, obviously, we see already in time price went way down here, but we gotta act like we don't know that due to us being traders right now. So originally, my full take profit would have been this level right here. Price comes down, we get a doji, we get a morning star, it heads back up. This is not a scenario where we're like, all right, we're just gonna take partial profit and get out. You can take partial profit when price is dropping and making lower highs and stuff, but once it got to your overall level, you potentially get out and reassess yourself. So after the trade is done, price, what does it do? Immediately creates a morning star, heads all the way back up. This little ellipse tool. Cool. Back to the daily. Right back over here. So you see clear as day. Price came down, placed the doji on the daily time frame, slowly headed back up to retest this 124 level, which is why it's imperative to keep these levels on here, because this is the original level we had. Now you see something profound, which would have told us that it was heading down some more. This level did not actually physically retest. It still was shorter than the others. So let me go back to the 1 hour time frame. So if you look at this level where we had the actual, retest 1, 2, 3, because remember, this was where it closed out on Friday, open on Sunday, retest, crossover, moving average down. When it came up to retest, what did it do? It did not retest accurately. On top of that, I see an actual counter trend line from here to here. Now, with the counter trend line, I will get more into that in series 2, but obviously what counter trend lines is, it's just a actual trend line that goes against the overall trend. So what that means is we have a counter trend line in place, and this is what I mean by, the more you're into my series 1, series 2, series 3, use your resources and put it all together, have some experience, some time, the more it all comes together and it makes sense. You got to use all your tools. Trading is not just some 2-step process or 3-step process. You got to use every part of your brain and your knowledge to really, put it all together. So we have price. We know price right here does not retest this actual major resistance. It comes down, comes up, creates what? A lower high, starts placing dojis. Lower high right there, lower high right here. And now we get this dump off right here. Come up, comes down. This is a 1 hour time frame. Let's go on to the 15-minute time frame, even farther down. Let's really get our sniper entries working. And we go right here, and we can see the moving average crossover clear as day. This doji right here, shooting star, comes down, confirmation. Now, the moving average crossover a little bit before that, but it was, consolidating right here. So obviously I would have waited for the break of consolidation and it closed. It closed right here. Your entry is right there. Amidst of this close. Stop loss right above this high. And now your take profit, we can obviously go down again. We can scale back in time. That was the 15-minute time. Let's go to the 1 hour now. Back to over here. Just past it. Right here. Cool. So, as for take profit, remember, this was our original first take profit. This one right here. So be smart about it. Remember I drew this white line over here where it stopped at? What did price do? Price came down on our first take profit and stopped right here. So feel free to adjust. Okay, it didn't stop here this time. It stopped a little bit lower. Adjust. Let me do that. Let me do horizontal ray. Adjust. Boom. Take profit right there. 1 to 3 risk to reward ratio. And then if price were to, hit this and come back down, hit this and come back, keep going down, then you can either take, re-enter, scale in, do what you got to do. But this is our first take profit, our overall take profit, excuse me. So price comes down and it never really gives you a lower high to really move your stop loss into profit in. So you really can't, you may got to keep your stop loss way up here. If you're an actual trader, you may have gotten stopped out right here because when price is going down and made just a little bit of a lower high right here, you could have put your, your stop loss in profit, and price would have came up, stopped you out somewhere in between. Here's 2 things you can do to counter effect that. If you get stopped out in profit, but you see the trend is still continuing, feel free to re-enter. So I see that if you put your stop loss right here into profit 2 ways, you could have easily left it as it is because it wasn't really no clear-cut signal. But if this is a clear-cut signal, then you put your stop loss right here. Obviously, keep the strategies going because over time, the discipline will make you a great trader. And then obviously, it goes up, takes you out. Boom, doji. Kind of a doji, not really, but a little bit of a doji, a little bit of a fake evening star. Comes down, moving average crossover. And then we are down and off to the races. So, obviously, in the long term, we keep it going, keep it going. Obviously, let's just do another entry. Entry would have been, obviously, evening star, confirmation, entry right there, stop loss right above here, and your take profit, again, since it obviously closed below there, we are looking for, obviously, a 1 to 3 risk to reward ratio. If I see it's 1 to 5, 1 to 1, 1 to 2, I won't enter. Let's see if this is 1 to 3. This just crossed 1 to 3. So, I would have entered this trade. Trade goes into profit. Trade comes back up, and then trade comes back down. And mind you, once it comes back up, creates this lower high, what do? Move your stop loss into break even. And this is still a little bit negative. So your stop loss isn't actually in profit right now because this lower high still is in drawdown a little bit. So now at least you are potentially will lose 5 pips, in your trade instead of 20 pips or 30 pips. So price heads all the way down, heads right to that take profit level, which is synonymous with all the way over here, boom, boom, boom. And then price goes up, creates a lower high again, moving average crossover again. And the process continues where it's like, all right, I'm out this trade. I could potentially enter this trade. So let me start, Xing some of these things out, And I see a actual Fibonacci entry that I could have entered right here. And I'll probably do that in one of my next videos as well, where it's a Fibonacci entry as well. So Keep working on your entries. Like I said, feel free to scale in. Keeps us a few rules into effect. Let me actually refresh this page and go all the way over really quick. Keep these rules into effect. I actually have a PDF you probably can download on the side, but I want to keep these rules that you guys have already in your mind. It is, don't be afraid to enter. Don't second guess yourself. Stop, Velvet. Don't be afraid to enter. Don't second guess yourself. If you see a lower high being placed in a downtrend or a higher low being placed in an uptrend, move your stop loss into take profit, obviously after you see a lower high or a higher low. Now, if you get stopped out, feel free to re-enter upon seeing price continue in your original direction. Like I said, I'll have all this in like a PDF you guys can download, but I want to make sure you guys understand that work on your entries. That is not the only way. You mix your entry work with your psychology. You stay disciplined, keep your risk management on 1,000. You will be amazed at where you are and how profitable you are. So I hope this entry work video 2 helped you guys a lot, and I'll see you guys in the next video. Originally, like I told you guys in my last entry work part 2 video, this is entry work part 3. Look at the daily to see where it was going to go. So I started off with the tweezer tops over here. Now look over here. Boom. Pushes up. Doji. Shooting star. Now you should obviously, the minute the shooting star closes, you obviously should head down there, see what goes on with it, and obviously, trade, and it's going down based off that alone. Now over here, this is where price gets really interesting. What do you see right here? It's a Friday. So price is not moving right now, but you get a doji right here. What does that tell me? That tells me price, low-key ran its course a little bit. You can see over here how that kind of goes in play with this one right here, this one right here. So the past few times it came to this 131.700 level, 132.00 flat level, it just crashed back down. I get to this level and price creates a doji. This is telling me that if we were to scale down, bearish engulfing, that we should be awaiting, and we got a moving average crossover, even though it's Friday. We got to see what the market wants to do on Sunday. My my bias for this pair, GU, is bearish right now due to what I just saw on the daily time frame. Now I'm scaling down. Since it closed on Friday, I do expect the market to retrace a little bit, maybe hit this level a few times and then drop. But unless I get an actual close above here, that daily told me a lot. And I do see potentially right here, either retesting or going just a little bit lower and then start creating the actual downtrend with obviously take profits starting right here, and then obviously the original line between here and here. Move this up a little bit. So obviously delete those as well. But that is how you use, like I said, this one's gonna be a little bit shorter because I just wanted to elaborate a little bit more. That is how you use the daily and seeing the actual candlestick patterns on the daily to kind of predict what the market is gonna do the next upcoming week or the next few upcoming weeks. You know what I mean? You come over here, you get, what do you get? You get consolidation, price breaks out, retest, and then pushes all the way up. It broke out on the daily and retested on the daily and continued on the daily. So that means you should have scaled all the way down to the 1 hour and found entries relating to over here to bring you all the way back up. Why? Because we started on the daily to see what did the candlestick pattern tell me? Like, what is it doing like last? What did it do? You know what I mean? Like, that's all you really have to look at when it comes to, most things here. We get a higher low here. We get a bearish engulfing here. Price heads up. Like, you can really much use this for pretty much the majority of pairs you have, where it's like you look at the daily and see what happens. You get a doji and then you get a hammer, aka a bullish engulfing as well. What happens? Price heads all the way back up. So just use the daily just to see what it did, recently, and then the most recent candlestick pattern the most obviously noticeable one, kind of use that to kind of guide your direction on where you're going to be trading and the bias you should be leaning towards based on what you just saw. So I just wanted to give that quick little extra note after the first 2 entry work videos, and I'll see you guys soon. Not break tests, breakouts and retest entries, so you guys know exactly where to get in when you see price consolidating and when it's about to break out, what you should do. So I have one here. I think I saw it in my last video of entry work part 3, where right here you can see a clear consolidation. So obviously everybody knows what consolidation is. Consolidation is when prices all jumbled up together and there's no overall trend. There's no uptrend, there's no downtrend. Prices going sideways over and over again. Nothing is going on in the market. So when you see a breakout and a retest, this is what you should be looking for. And I take away that retest. You should be looking for a retest. So when price is consolidating like this, you look for a breakout, whether it's below or above. Now, people may tell you, okay, what you should do is, place a buy stop right here and a sell stop right here, and wherever it hits, take the other one out. That's not how to accurately trade. You're going to get stopped out. Price is going to wick you out right here, get you in for a sell, and then go all the way back up, wick you in right here, and then draw right back into consolidation. Then you just lost both trades. Now you got to cancel both of them out. Don't do that at all. Wait for confirmation on what price wants to do. We already know that price is already in the uptrend based on this bullish engulfing right here on the daily. Remember I told you in the entry work video, look to see what the daily does and then follow trend. So daily bullish engulfing, continuation, moving average crossover, it's just up. Now it's a matter of it just consolidating, taking a breather. And I'll elaborate more in the market cycles, in series 3. But we get consolidation right here. Price, boom, hammer, breaks out, retest. That is exactly what you should be looking for before you enter. When price is consolidating, look for a breakout and a close below, not a wick. You got to wait for that. Wait for this entire candlestick to close. So don't get caught up in price coming down, but then it only closes right here. Because then the next, obviously, you got in for a sell and price closed way up here, and now you're negative and draw down, and then went all the way up here. So right now, price did this, close above. We can head down to the 2-hour candlestick. We can see clear as day. Price broke up, got to this high point, and then came down to retest. Whatever high point the price makes, that is your barrier for entry next time. Meaning, price came up here and it's coming down to retest. We don't enter unless price is going up right here. Unless price crosses this barrier again, we don't enter at all. Because we need to wait for price to break out at the high point, come back down to retest, and then continue to cross that high point. Because price is not going to cross this high point and then dip back below and fake everybody else out. No, it's not going to do that. So, price came up here, came down, retested. You don't enter right here. You could if you want to be aggressive, but I wouldn't. We got to, preserve our capital. Drag it over. Price comes here, finally touches it, and you can enter here, obviously, or you can wait for an actual close above, which you got right here. Either or would have been perfectly fine. Preferably the close above, only because price can easily do what it did just that and retest and then drop down. It can't close above, like I just said a minute ago. It can't close above and then drop back down. But the wick, just like I said down here with the whole, closing below, it can wick and then come back down. Wait for a close above. We get a close above. We look for a long position amidst this close. Stop loss right there. You take profit. For me in particular, my first key level is 1.30. That's the closest key level near me. I don't have it marked on, but I just know it by heart. 1.30 is the closest key level near me. You can see price clear as they stop in there. So my first take profit would be looking to aim for 1.30. Unfortunately, this is a 1 to 2.7 risk to reward ratio, so I probably wouldn't take this trade. Only because I only look for 1 to 3 and 1 to 4 risk to reward ratio, and that's a perfect example of sticking to your guns. No matter if I believe it's going to go up or not, there may be some times where I stay disciplined 90% of the times. So sometimes, I may not stick to the plan, which is, bad advice, and you guys should always stick to the plan in general. You know what I mean? But most of the time I try to stick with 1 to 3 and 1 to 4 risk to reward ratio. You know what I mean? Most of the time. So if I rewind back in time, you can see clear as day. Obviously, it would have been a good trade. Close above, never in drawdown. Stop loss right here. Heads all the way up here. And if you drag it over, it head all the way over here. My idea is that, I try to trade 1 to 3 and 1 to 4 risk to reward ratio because no matter if I lose 3 or 4 trades, all I got to do is 1 to 1 and I'm way in profit. 1 to 2 can work too. I draw the line at 1 to 1. Like, I don't trade 1 to 1 and even 1 to 2s. But I can see, if somebody told me their risk to reward ratio is 1 to 2, great. Cool. 1 to 1, that is just like, damn, like you really got to make sure you are way on point. You know what I mean? So this is a 1 to 2.7 risk to reward ratio, almost 1 to 3. A lot of people would have taken a trade, which they should have, because this is a breakout, retest, continuation. Simple. Very, very simple. And that is how you should look for all your trades. Remove this. Let's go back in time. Let's just see if we can find some more consolidation so I can show you guys, exactly what really could go on. I see consolidation right here. You see it right here. You can easily just go back in time. And I mean in time, I mean like go down to the 1 hour time frame. Look to see if there's a retest, continuation. So all you got to do, keep going down. Just spot areas of consolidation. Every time you see consolidation, draw a box around it and then scale down to like a 15-minute or a 1 hour time frame to see, all right, where is it breaking? Where is the retest? Where can I enter? Consolidation. How do you know this is consolidation? What is it doing? It's going down, up, down, up, down, up. There's no trend until it gets above. Once it gets above, what's the first thing it does? Consolidation, breaks above, comes down, retest. This was the high point. Let me actually delete this. This was the high point. And this is a daily time frame. I would usually do this on a 15-minute or an hour. I'm just trying to give you guys an example, of how you should look at it overall. Breakout or consolidation, breakout, high point, retest, comes up, takes it out. Your entry is right there, long position right there. And obviously you look back to see where your key levels are at. And obviously, anything remotely close, stop loss right over here. And obviously, you can go back in time to see where price would stop at. It's insane. Right here, their price stopped at for 1. Price stopped at here as well. I know I have a key level at 137,500 and 140 flat just off my key levels alone. I don't know why I went so far back in time. Where was it at? Right here. Okay, cool. Right? Oh, right here. Oh, okay, cool. So, yeah, so this is my first one based on what I saw in the past, where it stopped at 1 to 4.3 risk to reward ratio. Second one, 1 to 7.37 risk to reward ratio. And obviously, this lines up with my 1.40 overall key level just off knowing my levels in general, which I talk extensively in series 3. 137,500, which you can obviously see, price stopped right here. This is my mid level. I do trade the quarters theory a little bit, but I also put my own effect and kick into it, which you will see when I talk about the key levels and get into that section in the next series. But obviously, gets right here, here, and here. This is where you got to be. Your trading plan comes into place on where you're going to place your take profits. My take profits are always a key level, a Fibonacci extension, or a previous level that price stopped at in the past. And you can see clear as day, these have 2 out of the 3 except the Fibonacci extension, because there's no Fibonacci to really use here. So I hope this breakout video helped you guys out a lot. My dog wants to go pee right now. He's waiting by the door, so I'm just gonna go help him out right now. But when you see breakouts, I'm gonna come in a second, Velvet. When you see consolidation, look for a breakout. When you see a breakout, hold your guns. Do not enter the trade. Hold it. Be patient because it can easily fake you out. Wait for a close. Wait for it to retest, and then enter off that high point that price was at. And then boom, once it reaches there again, and then boom, you'll be good. And you will have a great entry and be in a great trade in
hang on, my dog really has to go pee. I'm gonna bring him outside while I still talk to you guys. So I want to end the video off right. Come on, Velvet. Ugh. Look at him running right to the door to go pee. Good boy, Velvet. Go. Yeah, so, oh my gosh. So, long story short, when you see consolidation, wait for the breakout, wait for a close above or below, wait for that retest, and then enter once it gets near that level again. Once you do that, you'll be fine, you'll be great, you'll have a great trade, you'll be disciplined. And even if that trade comes back to be a loser, you know, we're practicing discipline, we're practicing the strategies over and over and over and over again. Because over time, we'll be a great trader, we'll be an efficient trader, we'll be a consistent trader, and we'll be, most importantly, a disciplined trader. And a disciplined trader is a profitable trader. So I will see you guys in the next video, and I hope this video give you guys some insight to how to enter on actual breakouts.
So I want to talk to you about, exit strategies. We talked a lot about, entry work and setting up your charts. And, I want to talk about, getting out the trade. I'll explain more in terms of like partial profits and exact points, later on in the series, in series 3 and 4. But right now, I just want to give you, 3 key points on where your take profit should be. It should either be at a key level, like, like a major support or resistance, a minor level, which I consider, previous points where, price wicked at in the past. You see over here how price wicked here, wicked down here, wicked over here, over here, wicked right here. Like usually where price, wicks at, it leaves clues on where we'll do in the future. And lastly, a Fibonacci price point, 27 extension or 61.8. So I'll write that on at the end of the video. Actually, I'm gonna write it right now just so you guys can get a clear understanding. Let me clear this really quick. All right, here. So TPs, support / resistance, key levels, starts over, Fibonacci extension, 27 or 61.8, it's actually negative, excuse me guys, and previously wicked area. So, technical analysis, 2.0, back to the chart. So, just in general, when you're trying to take profit in something, look over here. So initially, if price is down here, I'm trying to give you guys some examples. If price is down here and I see it pushing up, mind you, this is on a daily, so you wouldn't be using this on an intraday time frame. This is more so for swing traders, but the strategy is still the same. I'm just looking at this because it's a lot easier to read instead of going down to the 5 minute and seeing a bunch of these candlesticks, you know what I mean? But just in general, if you see price right here, you see a bearish, a bullish engulfing and moving average crossover, and you get in. Let's imagine this was a 15-minute time frame, or the 1 hour or 2 hour. Your first take profit would be here because this is where price previously wicked in the past. Nothing says at all that price will burst through here and just head all the way up here or even further. So we want to make sure we protect our profits and we maximize, our earnings in our trade. So first take profit is here because you can't have multiple take profits. I'll get into that in series 3 in the partial profit section, but you can have multiple take profits. So first take profit is here, right here. And then a price were to break out of here, you got to look over here and see, like you always want to go back in time and see where price stopped at in the past. You see over here when price got here in March of 2020, it completely collapsed, just fell all the way to hell. You know what I mean? So when price is up here again, you want to be very mindful. So if you took, let's say you took all your money right here and it wasn't partial profit and you're looking to re-enter, I would be very wary in terms of, how profitable that trade will be, risk to reward ratio rise. Because if you are somebody who, in your strategy, mind you, your strategy is your strategy. I'm just giving you guys my strategy. Like mine is always 1 to 3 or higher. So if this didn't provide a 1 to 3 opportunity, I wouldn't have gotten in. But if you guys are 1 to 1 or 1 to 2, and if you want to get in, feel free to understand that price has to stop here due to what it did in the past. If it breaks above here, then we can start seeing, 136 levels, 135 levels, excuse me. This will be the next target. But you always want to go with what price did in the past. Just like I said in setting up your charts, you want to set up your charts. I don't know why I deleted the other one, the other key level. I'll bring that back on actually. I'm going to set up your charts, your majors, your minor level to try to keep the charts as clean as possible. And like I said, I have just these little lines, these horizontal rays over here. Horizontal rays are obviously not the same as the line. The line is fully long. A ray is just halfway or to the point where you click it at. So I like these a lot better because I can just kind of tell. But like I said, I'm more of a naked trader. Another example would have been the Fibonacci extension. So you can see clear as day. Another trade could have been. I'm not trying to tell you where to enter. I'm just saying where to get out. Like you get out at these levels, like this one. The price comes back down. I'm looking for it to break here after, like, obviously breaks below here. My next profit is, right here. And then we go below there. We're looking at right here. And then we're looking at right here. Like I try to go where price stopped at in the past. I do have major levels. I don't have them plotted on here right now. But I do know, at 1.30, 127,500, 125, the quarter theory, I use that as well. That is explained full detail in series 3. And I'm trying to get you guys to understand, because that's more of a swing trader's level. That's not more so for an intraday, if that makes sense. That's why I'm not explaining it in series 2. This series is for intraday traders who are trying to get in on Monday and get their money by